The country with the highest savings rate in Europe is also the country where savings are being eroded at an alarming rate, with a staggering 40% of German savers now holding negative interest rate accounts. This phenomenon is not limited to Germany, as countries like Switzerland and the UK are also experiencing a similar trend, with 25% of Swiss savers and 15% of British savers holding such accounts. And the reason has everything to do with the unintended consequences of monetary policy, which will lead you to wonder what other secrets are hiding in plain sight. In Germany, for instance, the Bundesbank has reported that over 1.5 million savers have been affected by negative interest rates, with some banks charging as much as 0.5% per annum on deposits, resulting in a loss of 1.2 billion euros in savings over the past year alone. And this number is expected to rise to 2.5 billion euros by 2025. Making you question how such a system can be allowed to exist in the heart of Europe's economic powerhouse, and what the true motivations are behind this policy. A case study of a typical German saver. Let's call her Frau Müller, who has been saving for over 20 years and has accumulated a sizable nest egg, only to find that her savings are now being eroded by negative interest rates, with her bank charging her 0.2% per annum on her deposit, resulting in a loss of 500 euros per year. And this is not an isolated incident, as a survey by the German Savings Bank Association found that 70% of savers are unaware of the negative interest rates being charged on their accounts. And this lack of awareness will lead you to ask what other surprises are lurking in the fine print. The mechanism behind this wealth erosion is a complex web of monetary policy and banking regulations, which allows banks to charge negative interest rates on deposits while paying 0% interest on loans, creating a system where the banks are essentially being paid to borrow money, while the savers are being penalized for saving, with the European Central Bank's quantitative easing program having injected over 2.5 trillion euros into the economy since 2015. And this has led to a situation where the banks are awash with liquidity, but the savers are being squeezed. And this will lead you to wonder how this system can be sustainable in the long term. The psychological dimension of this problem is equally fascinating, as people like Frau Müller are often unaware of the negative interest rates being charged on their accounts. And even when they are aware, they often choose to stay with their current bank due to a combination of inertia and trust, with a survey by the UK's Financial Conduct Authority finding that 60% of savers have never switched banks. And this lack of awareness and inertia will lead you to ask what other ways people are being trapped by their own financial decisions, and what the true cost of this inaction will be. To avoid becoming an unwitting debtor, there are 3 specific actionable steps that European savers can take. Firstly, to shop around for a bank that offers a positive interest rate, such as the German bank Consorsbank, which offers a 0.5% per annum interest rate on deposits. Secondly, to consider alternative savings options, such as the UK's National Savings and Investments, which offers a 1.5% per annum interest rate on its fixed-rate bonds. And thirdly, to take advantage of tax-free savings options, such as the German Riester pension scheme, which offers a tax-free return of up to 2% per annum. And this will lead you to take control of your finances and avoid the hidden wealth erosion. If you are still watching, you are already thinking differently from 95% of Europeans. Most people will watch this and do nothing. You are not most people. If this changed one thing in how you see money, press like. It takes 1 second and it helps more Europeans find this truth. Subscribe Tomorrow I am covering something that will make today look like a warm-up. I will see you there.